don't know about the rest of you, but I've been asked a lot recently about what's going on in the supply chain. Because most of you know that we have an expert in the supply chain industry. That's Jay Mintzmyer. I want to go ahead and introduce him into the conversation here. Jay, thanks for joining us today. I really appreciate you giving us the time.
Yeah, thanks for having me on here, Daniel. Certainly been wild times, as you alluded to.
Yeah, no kidding, right? So we have Russia and Ukraine still in the midst of a war. We're hearing updates daily now about diplomatic solutions possibly coming down the pipeline. Of course, Ukraine doesn't want to give up land. Russia, it sounds like there's a lot of, no starters really. But the market seems to be, down 3% one day, up 2% the next. And I can't help but think about your service because your service is still positive for the year, right?
Yeah, actually, as of earlier this morning, we were up 29% year to date. So that we're recording on March 9th. So as of this morning, we were up 29% on average year to date.
Yeah, and that's amazing, right? So I think a lot of people are realizing that no matter what's going on between growth, technology, NASDAQ hitting the bear market, I mean, what is it about the supply chain industry that makes you or puts you in a position to just have a continuous green year while the rest of the market is red?
Well, the big thing about, I guess, supply chain and shipping, and one of the things that makes our service a little bit different, and of course, we have a lot of room here to talk about the different segments and how they're impacted by this conflict. But the thing that makes shipping different is it's not just one little, one monolith. It's not all shipping's up green one day, all shipping's down red. There's actually about 6 different subsegments that we follow. So one of those would be tankers. Think about the oil tankers, the product tankers with gasoline and diesel. Another example would be dry bulk. Think coal and iron ore and grains. And then the final example, I mean, there's more than these, but the big 3 that folks think about, the big one would be container ships. And that was the huge boom last year on retail goods. So each one of those segments is reacting differently to Ukraine, whether or not tensions are going up or tensions are going down. So that huge market volatility is really giving us a lot of opportunities to build around our portfolios, trade around a little bit. And of course, we're all hoping for the best solution in this humanitarian crisis. I don't want to, come off it in sort of a profiteering angle or anything like that. It's nothing like that. But each different sort of news update provides a different avenue for investors to know where to be.
Yeah. So that leads me into my first question for you ultimately is there's a lot of investors that are on Seeking Alpha wanting to know right now, what should they be doing? So if they were listening to you, what would you say to them today?
So right now, today, we like the core positions in each one of the segments. So starting with dry bulk. Dry bulk is an unequivocal winner of this situation. And again, I hate to use the word winner because that's kind of a loaded word. But if you think about the trades that are being disrupted, the biggest one is going to be grains. Ukraine and Russia both are among the world's largest suppliers of wheat and some other agricultural products. The rerouting of those supplies, if they get rerouted from the Black Sea area over to China, for instance, China's a big importer of grains. That's going to lead to a significant increase in ton miles. And that's how you calculate shipping demand. It's not just total consumption or total production. You have to look at how much volume is moving and how far it's moving. So historically speaking, conflicts, disruptions, even wars can actually be bullish for shipping stocks or shipping companies, which of course leads to the stocks. So that at first, folks think, one of the generalist reactions, gut reactions is conflict, war, decreases in global activity. That's negative for shipping. That's a generalist reaction to the market. But in reality, some of these disruptions can actually be bullish.
Yeah. And so you're saying they're bullish, but I'm thinking, oil's made this move. I want to go and pull it up real quick here on Seeking Alpha. Crude today is at 116, right? And we know that you follow the oil tankers. We know that you're in container ships as well. But is this move already done? Like with a move like this in oil, are we already seeing the stock moves for oil tankers? I mean, to frankly, pun intended, have we missed the boat?
Well, the thing with tankers is, again, it really depends on the ton mileage. The price of oil is kind of irrelevant to a certain point. Obviously, if we got extremes, when I say extreme, I'm talking like $200 a barrel. That could lead to demand disruption around the world. That would be bullish or bearish if it got to that extreme. But in terms of whether or not oil's 110 or 120 or 100, it's kind of irrelevant for the tanker demand. You have to look at the routing of that oil and where it's going. And with the recent news of the U.S. cutting off Russian oil imports, and my expectation is that most of the European Union is going to follow suit. That means that those oil tankers out of Russia are going to have to be rerouted to further sell their oil to more friendly target markets. So think of all that oil getting rerouted all the way around to China or perhaps India. India might be a buyer of some of that oil. That's a lot further than sending that oil up to Northern Europe, right? That's a much further haul for Russia out of the Black Sea. So that's actually bullish for tanker ton miles. And I think we've seen some of that reflected in the stocks. If we look at the tanker stocks today, they're down. But it's hard to tell whether or not they're down because of first order effects, if they're just correlating with oil. That usually seems to be the case. And it's always been profitable for us because when oil's up, tanker stocks tend to move knee-jerk reaction. And when oil's down, vice versa. But what we do is we look more so at the longer term impacts of the ton mileage shift. So just because tankers are up one day, it might actually be a time to buy or a time to sell, depending on those ton mileage shifts. So a bit of a roundabout answer there, Daniel, but I guess the takeaway point is oil tankers are much different than the oil price market.
All right. Well, now then, if you're talking about that's oil tankers, let's go back to container ships real quick. So, over the months, we've been following the number of ships off the coast of California. Has there been any update there? Is this going to get worse? Are we seeing that, get better? Is that going to help bring inflation down? Is that all kind of tied together?
Yeah, it's a little bit different from the Ukraine disruption. It's almost a completely different story. What we're seeing on the West Coast is more of seasonality. We had the Lunar New Year in China, which every year leads to a manufacturing slowdown, a decrease in exports around the late January to about middle of March timeframe. We also had the Chinese Olympics, and China pushed really hard to lower pollution, which meant they were also doing industrial curbs and that sort of thing. On the West Coast, at the same time, there's always a seasonal decrease in imports right after the holidays. Right? You think of all these retail companies like Walmart, Amazon, Best Buy, et cetera, stocking up ahead of Black Friday, ahead of Christmas. There tends to be a little bit of a lull, January, February, March, and then things start to pick up. Usually April, May, June is when things start lifting back up. You start getting like the back to school stocks, and then you get Thanksgiving and fall, autumn, you get it back into the holiday season. So what we're seeing on the West Coast is congestion's coming down a little bit, but it's still significantly elevated above normal levels. This is the chance to get congestion down. If you don't get it down by about middle of April to May, you're kind of screwed because, first of all, we have a union negotiation that's coming up in June, which could cause all sorts of disruptions. And then secondly, once you get to June, you're talking about holiday stock for 2022. So this is their window, and they're doing decently at it. Again, it's above elevated levels, but it is down from the peaks. However, one caveat to that is we've seen elevated congestion, basically near record highs on the East Coast. You might say, well, why is that? Well, a lot of shippers realized that LA and Long Beach were a total mess. And so they rerouted a lot of their cargoes through the Panama Canal over to the East Coast. So now it's kind of like, robbing Peter to pay Paul, because you've improved things a little bit on the West Coast, but the East Coast is nearing record congestion levels. And I'm sitting here as a U.S. consumer, a U.S. citizen, and I'm really hoping we can get these congestion levels down by middle of April. Because if we don't get that done by middle of April, we could be in some serious hurt in terms of shipping costs, import prices. Now, as a shipping investor, those congestion things can be very, very helpful. I mean, as we've seen in the stock price performances, but it's a balance, and I would like to see throughput improve.
Yeah. Now, I just want to take a moment to mention real quick, you are the founder of Value Investors Edge, a marketplace service here on Seeking Alpha, and you've always had the expertise about supply chains, and you've shared that with your audience time and time again. And there is a free trial that you do offer. I would encourage everybody to go check that out right now, because we have a lot going on that we've talked about, right? We've talked about Ukraine and Russia. We've talked about container ships coming down in volume off the coast of the West Coast of America. So what are you kind of telling people what's to expect next, right? If we see, I know there's a lot, right? There's the potential of a ceasefire. There's a potential of escalation of war. There's potential for container ship to start increasing again. But what are you recommending to people right now?
Yeah, so I mentioned earlier that dry bulk was one of the core areas we're focused on. And there's really one pick that I've mentioned a few times publicly already. To be fair to the members of Value Investors Edge, I won't divulge, of course, the entire model portfolio and all our top picks. But I think one name that I have mentioned a few times, which is a clear beneficiary of this entire situation, is Eagle Bulk Shipping, EGLE. Should disclose I have a long and trading position in there as well. So folks are aware, we're recording on March 9th. That can change in the future based on where the stock price goes, of course. But Eagle Bulk is a clear beneficiary because they are entirely in the mid-sized dry bulk segment. They own Supermaxes and Ultramaxes are the name of their ships. And these are primarily, they do everything, but primarily heavy in the grain trades and a little bit of the coal trades. And the grains and coals are the ones that are being rerouted by Russia and from Ukraine as well through the Black Sea. And so there's disruptions. And of course, there's a caveat or a spectrum of disruption. I mentioned that historically conflict and even war can be bullish if there's disruptions and delays. And that's because it makes the fleet on the water less efficient. Right? You think about these ships, they're sitting around waiting to load the cargoes, there's more inspections, they have to take longer routes to stay away from conflict zones and whatnot. But if it leads to an absolute destruction of supply or demand, that would be bad. Right. So like if crops get devastated, destroyed, and they never get replanted for a year or two, that would be bad. So I do want, caution folks that it's a spectrum. And right now, the spectrum we're seeing, I would say is from a shipping perspective is very bullish because it looks like we're starting to see, dovish tone resuming. We're starting to see talks resuming. I don't want to get too far ahead of myself. Again, March 9th, this is such a dynamic situation. Things change every few hours, quite honestly. But what we're seeing right now is it looks like these sanctions are going to stay on for a long time. These cargoes are going to be rerouted significantly, but it looks like some production, the grains and stuff are going to come back online and be exported soon.
Yeah. Jay, I really appreciate your insight. I know all of our audience members do as well. And just a reminder for everyone, this is Jay Mintzmyer from Value Investors Edge, our supply chain expert, and he has a free trial going on for everyone right now. So make sure you go to seekingalpha.com and you can check that out today. Jay, thank you so much for your time and have a great rest of the week. Okay.
Thanks, Daniel.